What's up guys, welcome to Pounds Invested. I'm your host, Stephen Georgiev. Before we get into today's video, I really want to thank those of you who have subscribed to my channel already and who have viewed my other videos. So, in my last video, I explained what index funds are and why they're a great investment over time. If you haven't seen that one yet, click the card up here to go watch that one first, before in this video we jump into a detailed tutorial about how to build an index fund portfolio. So with that said, let's jump into some of the things that you need to look for when building an index fund portfolio. The first thing to look for when choosing an index fund is what's called the expense ratio. So what's an expense ratio? It's the bit that's skimmed off the top of your investment which goes to pay the fees to use the service. Now, we don't really mind paying this fee because the alternative would be you as an individual going to buy tiny little fractions of each of the companies in the particular exchange. And that really wouldn't be practical. So what's the important thing to look out for with an expense ratio? Well, you don't want to be paying more than 0.4% per year. Now, if you're thinking 0.4% per year, no, it's far too cheap. I don't mind paying 1 or 2% per year. Well, hold that thought, because as we can see in this chart, the difference between paying 0.4% per year and paying the equally low sounding 1.6% per year is almost £80,000. Essentially, you're throwing away half of your investment returns if you don't control your expense ratio. So tip number one, control that expense ratio. Don't pay over 0.4% per year. With that in mind, as we can see from this particular fund from Vanguard, it has an expense ratio of just 0.06% per year. What does that look like in practice? Well, if you invested £10,000, you'd only be paying £6 per year. Peanuts! And that's exactly how it should be. So what's the second thing we should be looking for when choosing an index fund to invest in? Well, the second thing is automatic reinvestment of dividends. So when you invest in the stock market, you get a dividend each quarter. That's almost like a reward for owning that particular investment. But you don't just want to leave that spare cash laying around on the sidelines. No, you want to make sure that the fund that you're interested in investing in automatically invests that spare cash so that it grows more in the future. So that your dividends are reinvested, at least to higher growth, and more dividends, which are then reinvested, so then higher growth, and then more dividends. But is it really that big a deal if you decide not to reinvest your dividends? Well, actually it really can be over time, yes. So this chart shows the difference in investment returns between reinvesting your dividends over time and leaving them on the sidelines. The difference between reinvesting and not reinvesting your dividends over time can be £70,000. That's crazy! Reinvest those dividends! Now, how do you know whether a particular fund you're interested in is going to automatically reinvest the dividends? Well, in the UK, funds generally come into two categories, accumulation and income. An accumulation fund will have the word accumulation in the name, and that will automatically reinvest your dividends. An income fund, which typically has the word income in the name, will leave the dividends lying around on the side. Now, there are some cases when an income fund is preferable. For example, if you already have a large investment portfolio built up and you simply want to be able to retire in Thailand and not really have to do anything and just take the dividend income that comes from your investment without ever touching the principal. But let's assume you're trying to grow an investment portfolio in the first place. That's why you'll need automatic reinvestment of dividends, and that's done using what's known as an accumulation fund. The third thing that you should look for when choosing an index fund is transaction fees. These are fees typically charged on entry and on exit. So whenever you first decide to buy into the fund, and then when you decide later on to sell out of the fund. Some funds will charge you for both, some funds will charge you for neither, some funds will charge you for one or for the other. I really like Vanguard's investment platform because they charge you neither transaction fees on entry nor on exit. But what happens if you want to invest in, say, a Fidelity fund but you have a Vanguard account? Well, if you wanted to invest in an external fund, so a Fidelity fund through your Vanguard account, or a Vanguard fund through your Fidelity account, then you'd most likely face an out-of-platform charge, which can be anywhere around about £30 to £50. So let's avoid those. And the way to do that is to stick to investing in funds which are available through the platform that you choose. Some platforms to look out for are personally my favourites: Vanguard, Fidelity, and in the UK, iShares or AJ Bell. So they're the top 3 things to look at when choosing an investment fund, beyond the obvious things like, for example, the rate of return. So we know that past performance is no guarantee of future success, but we don't want to be buying into a fund which over the past 10 years hasn't delivered really any significant returns, do we? So just to summarise so far, we want to look at the expense ratio, keep that below 0.4%. We want to look at transaction fees, and hopefully with a platform like Vanguard or Fidelity, they don't charge you entry or exit fees. And we also want to look at automatic reinvestment of dividends to make sure that we get the maximum amount of capital growth over time. The only exception to this rule is if you already have an investment portfolio and you simply want to relax in Thailand and draw an income from it. For most people watching this video, I assume they're more interested in growing an investment portfolio in the first place, and for that, you'll really need automatic reinvestment of dividends with an accumulation fund. Now that we've covered the criteria for choosing an investment fund, what are some investment funds which might be a good place to start? Now I should say that this is not an explicit recommendation to buy, sell or hold any investments, just a starting point for your own research. With that said, Vanguard offers a wide variety of funds. One fund which is quite interesting is called the Blended Life Strategy 80% Fund. Now this is the ultimate set and forget fund. It contains 80% stocks and 20% bonds. We'll come on to why that's important in a couple of minutes, but it already contains a portfolio which is ready-made for you. You simply buy into it and that is that. But let's say you wanted to build your own portfolio. What funds could you use to do that? Well, one UK fund is called the FTSE UK All Share Fund. That's entirely invested in UK companies and has an expense ratio of just 0.06%. Now, a US equity fund, which has a similar strategy, is called the US Equity Index Fund. You'll see Vanguard's quite unimaginative with its funding names, and that's not a bad thing. But the US Equity Index Fund has an expense ratio of 0.1%. Again, it fits our criteria of being below 0.4%. So looking at emerging markets then, we can look to Vanguard's Emerging Markets Index Fund. This has an expense ratio of 0.23%. Again, well within our 0.4% barrier. Now, if we wanted to invest in some bonds to limit our exposure to equity markets, we need look no further than either the UK or US government bonds. These are super safe, super secure bonds because neither the US nor the UK government is going to go bankrupt anytime soon. One really easy way into these funds is, as you might have guessed, something simply called the UK or US Government Bond Fund. These funds, both of which, have an expense ratio of 0.12%. But let's add a bit of international flavour to our portfolio now, shall we? Well, we can look at the FTSE Global All Cap Index. This is made up of companies all over the world. So this eliminates our exposure to geographical risk of investing in companies purely in one country or in one continent. So the FTSE Global All Cap Index has an expense ratio of 0.23%. So far we've looked at what an index fund is briefly, we've looked at what the criteria are that you should be considering when investing in an index fund, we've looked at where you can start your research when it comes to choosing which investment funds to buy, and if you're enjoying this video, remember to hit the like button and subscribe to my channel. Now, on to part 4 of our video. How much of each fund should you buy? This is what's known as your asset allocation. Now you want to have a mixture of funds in your asset allocation purely because you want to limit your exposure to any one particular set of risks. Be that risk in any one particular sector of an economy, like finance or tech stocks, or also risk in any one particular region, like for example Europe or the US. Now, one asset allocation espoused by a guy called Jack Bogle, who's the founder of Vanguard and basically the grandfather and all-time master of index fund investing, is to take whatever your age is away from 100 and then that's the proportion of your fund which you should invest in stocks. So if you're 30 years old, that means that your portfolio should be 70% invested in stocks and 30% invested in bonds. This will guarantee, according to Jack Bogle, the best returns for you over time. Now, a slightly fancier asset allocation is to invest 30% of your portfolio in UK and US equities. You also want to look at investing 15 to 20% of your portfolio in international stocks. So that's countries like Japan or China or Indonesia or emerging markets or French companies or other European companies, just to get some diversification. You also want to look at investing 10% specifically in an emerging markets fund. This will guarantee that you're well placed when it comes to high growth companies in high growth economies. Beyond that, 30% or so is a good figure for investing in bonds to limit your equity risk, like we covered earlier. Now, you can look no further than the UK or the US for investment grade bonds. So at this point you might be thinking, I want to add a bit more excitement to my portfolio. Well, okay, two ways you can do this. One is by investing in property through what's called a real estate investment trust. Basically what this is you're buying a tiny slice of a company which has hundreds, or in some cases thousands, of individual properties in any one country, be that in the UK or worldwide. So that's quite a good way to get exposure to property in your portfolio. One other way to spice up your investment portfolio, like I covered in a previous video about gold, the card for that's up here by the way, is investing in gold. A good starting point for this would be to invest 5 to 7% of your portfolio in gold. Now, you can't invest in either a real estate investment trust or in gold through a platform like Vanguard. So look out in the description below for my tips for investing in real estate investment trusts and in gold. So now that you've done all that, your investment portfolio should look something like this. This will guarantee you the most diversification in terms of risk, and it'll also guarantee you enough exposure to companies in high growth markets, in high growth sectors of the economy going forwards. So hopefully in 30 years time, when you've literally done nothing other than invest, buy, hold, buy some more, reinvest my dividends, buy some more, keep holding, then hopefully you'll be able to retire yacht rich in Monaco somewhere. Thanks for watching this video, guys. If you found it useful, remember to like the video and subscribe to my channel. In my next video, I'm going to be covering common investment mistakes to avoid. So just as in this video I've told you how to build an investment portfolio for the long term, in my next video you'll be finding out things to consciously not do. So if you want to find out what not to do when investing, be sure to watch that video and I'll see you there.